Welcome to the Opening Bell Report.
You know, there's a very specific and really uncomfortable feeling you get in the stock market sometimes. It's kind of cognitive dissonance. It's what happens when you stare at a stock chart that looks like a crime scene, just red lines everywhere, steep slides straight down.
Right.
But then you look at the company's bank account and it looks like they just won the lottery.
It's the rich but failing paradox. It really messes with your head. You see the price action screaming, "Get out, this is a disaster." And then the balance sheet is just whispering, "Come closer, look at all this cash."
Exactly. And that is exactly where we are parked today. We're doing a deep dive into BigBear.ai, ticker symbol BBAI. And looking at the research you've pulled together, the question on the table is pretty high stakes.
It is.
We're looking at a stock trading around, $4.08 as of mid-February. Is this a falling knife that's going to take your finger off if you try to catch it? Or is this a bargain bin opportunity that is sitting at the bottom, fueled up and just waiting to blast off?
It is a classic battleground stock, and I really don't use that term lightly. You've got a share price that has slid, about 22% in just the last month?
Yeah.
So if you're a technical trader, that chart looks ugly. I mean, really ugly in the short term. But, and this is a huge but, if you dig into the 10K filings and the acquisition documents, which is what we're here to do, you find a story that isn't really about failure. It's about a very messy, very aggressive transition.
And that's our mission for this deep dive. We are not just looking at the ticker price. We are going to unpack a company that is trying to pivot and pivot hard into generative AI while navigating this literal war between short sellers and value buyers.
Right, because BigBear.ai is, at its core, a defense contractor trying to reinvent itself as a tech darling. And honestly, the surface level numbers are just confusing. You have revenue dropping, but you have hundreds of millions in cash.
You have huge operational losses, but then technically a positive net income on the report. It's a puzzle.
It's a total puzzle.
So we've got a David versus Goliath competitive landscape to look at, an accounting anomaly that I think is definitely going to trick some rookie investors, and a very specific mechanic, a short squeeze scenario that could send this thing vertical.
Yep.
But before we get to the fireworks, let's start with the identity crisis. Who or what actually is BigBear.ai?
Well, if you strip away all the marketing buzzwords, BigBear.ai operates at the intersection of, artificial intelligence and national defense. Specifically, they focus on something called decision intelligence.
Okay, stop right there. Decision intelligence.
Yeah.
That sounds like the kind of corporate jargon that gets thrown around in a boardroom to justify a consulting fee. What does it actually mean in practice?
That's a fair pushback.
If I'm a general in the U.S. Army, what am I actually buying from them?
Okay, so think about the modern battlefield. It isn't just tanks and soldiers anymore. It's data. You have logistics data, supply chain spreadsheets, satellite imagery, troop movements, fuel consumption rates.
Just a total mess of information.
A total mess. And the problem is, none of these data sets talk to each other. They're disparate. So you have a general staring at 50 different screens trying to guess what happens next.
So the general has a mountain of data, but no idea what to do with it. It's just information overload.
Exactly. BigBear.ai builds the software layer that sits on top of all that mess. It aggregates the data and it turns it into actionable insights. It's outcome-based planning.
So instead of a spreadsheet with a million rows, the system says what?
The system says if you move Battalion A to this location, you will run out of diesel in 48 hours unless you reroute this supply convoy now.
So it's essentially a crystal ball for logistics. That sounds incredibly valuable.
It is. It's a crystal ball backed by math. But here is the catch, and this is why the stock is in turmoil. That is their legacy business. That's the old Big Bear.
Right.
And they are aggressively trying to pivot away from just doing that toward generative AI.
And we see that in their shopping list, right? And they've been spending some big money lately.
They have, and this is critical to the bull case. In December 2025, they acquired a company called Ask Sage for $250 million. Then, in January 2026, they picked up assets from a company called CargoSeer. These are not small moves.
Let's double click on Ask Sage for a second. Why spend $250 million on that? I mean, everybody has a chatbot now. Is this just them trying to jump on the bandwagon?
No, and this is the important distinction that a lot of people miss. You can't just use ChatGPT in the Pentagon. You can't type classified troop locations or nuclear launch protocols into OpenAI's servers.
Right, massive security risk.
It's a huge security risk. Ask Sage is essentially a secure wrapper. It allows government agencies to use the power of large language models, LLMs, but in a completely secure, compliance-ready environment.
I see. So they're buying the clearance, essentially. They're buying the ability to bring AI into the locked room.
Exactly. They are buying the infrastructure that makes AI legal for the military to use. They are trying to prove to the market that they are not just a boring, slow-growth defense contractor anymore.
They want to be viewed as a high-growth tech play.
That's the goal.
Okay, so they're trying to glow up.
Yeah.
They want to be the cool AI kid on the block.
Yeah.
But they're not the only ones in this neighborhood. And this brings us to the elephant in the room.
Yeah.
You can't really talk about BigBear.ai without talking about the Goliath they are up against.
You mean Palantir?
I mean Palantir, ticker PLTR. Everyone knows them. They are the absolute darling of the defense AI world.
So how does Big Bear compare? Are they just a cheap knockoff?
This is maybe the most critical comparison to understand if you're an investor here. Think of Palantir as the comprehensive operating system for defense. It's like buying Microsoft, Windows, or iOS for the entire military.
Okay.
It is massive, it connects everything, it is incredibly sticky, and it is very, very expensive.
Right, and once you install an operating system across the entire military, you don't just, switch it out next Tuesday. It's permanent.
Exactly. Palantir creates massive vendor lock-in. Once you're in, you're in. BigBear.ai, on the other hand, is positioning itself as the agile, modular alternative. The David in this scenario.
They are the David. They're betting that the Army doesn't always want to buy the entire operating system. Sometimes a specific unit just wants to buy a module or an app to solve one specific problem like managing fuel in the Pacific Theater.
That makes sense. Not everyone needs the full suite. Sometimes you just need a calculator, not the whole computer. But here's what I find fascinating from the analysis. The valuation gap between these two is just wild.
It's night and day. Palantir trades at these massive earnings multiples, sometimes 200 times earnings. They're priced for perfection. BigBear.ai. They're trading on revenue multiples, around 10 to 12 times sales.
So why is the market treating them so differently if they're in the same sector? Is it just brand recognition? Or is there something deeper?
It comes down to one word: profitability. Palantir has proven it can scale and, print money. They generate massive free cash flow. BigBear.ai is still operationally unprofitable. And not only that, they're in a shrinkage phase regarding their legacy revenue.
Okay, let's get into that shrinkage, because when I looked at the financial report, it was a bit of a roller coaster. I felt like I needed a degree in forensic accounting to understand what was going on. Let's start with the bad news.
The bad news is top-line revenue. In Q3 2025, they brought in $33.1 million. Now, believe it or not, that actually beat analyst estimates.
A beat is good. Usually a beat sends a stock up. So why is the sentiment so negative?
A beat is good, but context is better. That $33.1 million represents a 20% decline year over year. Their business is shrinking.
Ouch. So they beat the estimate only because the bar was, on the floor.
Pretty much. And the reason for the drop is that they are winding down those legacy Army contracts we talked about, the boring logistics stuff. They're shedding the old skin to grow the new Ask Sage skin.
Right.
But right now, the old skin is peeling off faster than the new one is growing.
That is a vivid image and slightly gross, but I get it. Okay, so revenue is down. But then I looked at the bottom line, the net income, and it said positive $2.5 million. And I thought, wait, you just said they were unprofitable? How can they have positive net income if they're losing money? Is the report lying?
This is the trap. And I cannot stress this enough. You have to be so careful here. That positive $2.5 million in net income is what we call a false positive.
A false positive. Break that down. How does a loss become a gain on paper?
It's an accounting anomaly. It's related to warrants and derivatives. Big Bear issued warrants in the past, basically giving investors the right to buy stock later. On the balance sheet, those warrants are listed as a liability.
Okay, I follow you so far. Warrants are a debt they owe, essentially.
Right. But here's the kicker. The value of that liability is tied to the stock price. When the stock price goes down, the value of the liability goes down. In accounting terms, a reduction in liability counts as income.
Wait, hold on. So because their stock price crashed, their debt looks smaller and they counted that as profit.
In a nutshell, yes. It's non-cash paper income. It is not money they made from selling software to the Army. If you look at their operating income, which measures the actual business of being a company, they lost $9.4 million.
Okay, that is a huge red flag for anyone just skimming the headlines. Do not be fooled by the positive net income. The business is still burning cash.
Correct. If you stop reading there, you think the turnaround is complete. It isn't. But, and here's the plot twist, despite burning cash operationally, they have what we call a fortress balance sheet.
And this is the part that surprised me the most. Usually, a company burning $9 million a quarter with a $4 stock price is on death's door. You expect to hear rumors of bankruptcy.
Right.
But these guys, they're rich.
They are surprisingly liquid. They have approximately $715 million in cash and liquidity.
$715 million. That's almost $750 million. That's huge relative to their market cap.
It is a massive war chest. They raised capital and converted debt recently to secure this. And what this means is that unlike back in 2024, Bankruptcy risk is completely off the table for the next 2 to 3 years.
That changes the whole risk profile, doesn't it? I mean, usually when a company is shrinking and losing money, you worry they're going to go bust in 6 months?
Exactly. The cash gives them a runway. It buys them time to make this Ask Sage acquisition work. It puts a hard floor under the chaos. Even if they burn $10 million a quarter, they can keep the lights on for years.
Okay, so we have a shrinking business, but a mountain of cash. That sounds like a stable, maybe even boring situation. But then you look at the trading data, and this stock is a powder keg. Let's talk about the blast-off.
This is where the technical traders and the apes get excited. We are looking at a potential short squeeze setup.
For those listeners who might not be day trading every day, let's break down the short squeeze. What is the specific setup we're seeing here?
So shorting a stock means you're betting it will go down. You borrow shares, you sell them immediately, and you hope to buy them back cheaper later to return to the broker. The difference is your profit.
Right.
Right now, the short interest in BigBear.ai is at 27.8% of the float.
27.8%. Put that in context. Is that high?
That is extremely high. Anything over 10% is notable. Over 20% is rare. Nearing 30% is a crowded theater with everyone standing near the exit. It means almost a third of the available shares have been sold short.
And the analysis report mentions days to cover is around 2.2 days. What does that tell us?
That metric is crucial. It means that based on the average daily trading volume, if all the short sellers wanted to buy back their shares to close their positions, it would take more than 2 full days of buying every single share traded just to do it.
So they can't just sneak out the back door.
No. If the price spikes, it's like a stampede through a narrow doorway.
So play out the scenario. Say some good news hits. Maybe the Army announces a massive contract for Ask Sage, or the next earnings report shows the bleeding has stopped. What happens?
Well, the price starts to tick up. The short sellers start losing money. They get margin calls from their brokers demanding more cash. They panic and try to buy shares to get out and stop the bleeding.
But their buying drives the price up even more.
Which panics more short sellers. It's a feedback loop. That is the blast off.
And we've seen this before in other stocks like GameStop or AMC. It's violent.
It is. And BigBear.ai has a beta of 3.45.
Beta measures volatility, right?
Yes. A beta of 1 means you move with the market. A beta of 3.45 means this stock tends to move 3.5 times as hard as the market. If the S&P 500 goes up 1%, this might go up 3.5%. If the market drops, it crashes harder. It is not for the faint of heart.
So we have the fuel for a rocket launch, high short interest, high volatility, but we don't know if anyone is going to light the fuse.
Precisely. A squeeze needs a catalyst. Without news, the shorts can sit there comfortably while the stock just drifts sideways or down.
Let's look at the chart, because technical analysis usually gives us a hint about sentiment. The analysis mentions a falling wedge. Now, I usually prefer wedges of cheese, but tell me what a falling wedge means for a stock chart.
A falling wedge is a technical pattern that it looks like a cone pointing downwards. Paradoxically, in technical analysis, it's often considered a bullish reversal signal.
Wait, the chart is pointing down, but that's good. Why? That feels counterintuitive.
It suggests that the selling pressure is getting exhausted. The price swings get smaller and smaller as it goes down, indicating that the bears are running out of steam. They've sold all they can sell. The volume is drying up.
So the sellers are tired.
Exactly. And combined with the RSI, the relative strength index, approaching oversold territory, the technicals are screaming that the rubber band has been stretched too far to the downside. It wants to snap back.
And we are sitting right at that $4 mark. The report calls this a psychological and structural floor.
$4 is the line in the sand. If it breaks below that, the next support is around $3.50. But this is where the fundamental story and the technical story meet. Because they have that $715 million in cash, it's very hard for the stock to fundamentally drop too far below its cash value.
Right, because at a certain point, you're essentially buying the cash for free.
Exactly. If the market cap drops too low, the company becomes worth more dead than alive. That cash creates a natural barrier, a safety net that pure tech stocks often don't have. It gives value investors a reason to step in, even if they don't care about the short squeeze.
Okay, let's talk price targets. If I am an optimist, if I believe in the Ask Sage pivot, where is this going?
The bull case is sitting at $8.40. That assumes the Ask Sage acquisition is a home run, the integration is smooth, and defense spending ramps up. That's a double from here.
And the bear case. If the revenue just keeps shrinking and the pivot fails.
The bear case is $5.05.
Wait, hold on. I need to check my math. The stock is at $4.08 today. The bear case, the pessimistic things go wrong view, is $5.05. That's still higher than where we are now.
That's the anomaly of this current moment. The average analyst target is $6.46, which implies nearly 58% upside. The analysts seem to think the sell-off has been overdone. Even the skeptics think it's undervalued relative to that cash position.
That is wild. Usually the bear case is you lose everything. Here, the bear case is you only make a 20% return. It almost sounds too good to be true.
Well, keep in mind, markets are irrational. Just because the target is 505 doesn't mean it can't trade at $3 for a while. The market can remain irrational longer than you can remain solvent. But yes, the risk-reward ratio is skewed heavily to the upside if, and it's a big if, the pivot works.
So I have to ask you the $1 million question, or I guess the $4 question. Is this the bottom?
It is likely close to the bottom. I say that because of the cash. It is very difficult for a company with no bankruptcy risk and that much liquidity to trade significantly lower without some catastrophic new information like Ask Sage turning out to be a fraud or the CEO quitting.
But is it the bottom before the blast-off?
That is the speculative part. The blast-off relies entirely on the mechanics of the market, the short squeeze. Fundamental investors are sitting on their hands. They are waiting for 2 or 3 quarters to see if Ask Sage actually adds that projected $50 million in annual recurring revenue. They want proof of life.
So the investors are waiting for proof, but the traders are watching the fuse.
Exactly. If you buy here, you have to know which game you are playing. Are you investing in the business transformation, which takes time and patience? Or are you gambling on the squeeze, which could happen tomorrow or never?
It really is a fascinating setup. You have this company that was a SPAC, dropped 90% from its highs, survived when others died, and is now sitting on a pile of cash trying to become the next big AI player.
It's a survivor. And in the defense sector, survival is half the battle. They have shed the weight, they have the capital, and now they just need to execute.
So let's summarize this for our listener. We have BigBear.ai, the bad. Legacy revenue is dropping 20%, and they are operationally unprofitable. The good, a massive $715 million cash war chest that guarantees survival for years. The ugly, a highly volatile chart, but the potential, a massive short interest of nearly 28% that could trigger a violent squeeze if any good news drops.
That's the snapshot. It's a coiled spring. The market is currently pricing BigBear.ai like a struggling contractor, but the short interest suggests traders are betting on a disaster that the balance sheet says simply won't happen.
That is a powerful divergence. It feels like the market has mispriced the risk because they're looking at the past revenue, not the current bank account.
And that leads to the final thought I'd leave you with. We often look at stock prices as truth. If it's down, the company must be failing. But here, the price might just be reflecting the uncertainty of the transition, not the reality of the resources they have.
Right.
The question is, are you patient enough to wait for the business to catch up to the balance sheet, or are you just looking for the adrenaline rush of the squeeze? Because the timeline you choose dictates whether $4 is a steal of a lifetime or a dead money trap that ties up your capital while you wait.
A great reminder that in the market, timing isn't just everything. It's the only thing. Thanks for unpacking this with us. It's going to be an interesting one to watch from the sidelines or maybe from the roller coaster seat.
Ideally with a safety bar down.
Ideally.
Yeah.
Thanks for listening to this deep dive into BigBear.ai. We'll catch you on the next one.
Don't forget to like, share, and subscribe for more.